Okay, good morning, everyone. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, March 3rd. Michael Boutros here with you this morning, guys. Great to see you. Joe, Horace, Graham, Hussein, Joe, Eileen, great to see you guys. Danny, great to see you in the room. We just got the release of the non-farm productivity coming in slightly better than expected. We were looking for a decline of 2.9%. This is the final read for fourth quarter, guys, so it's just the revisions. You saw a slight upward revision for the non-farm productivity, not a major print. Unit labor costs slightly downward revised to 3.3%. More importantly, heading to tomorrow's non-farm payroll report, you saw initial jobs claims today come in right in line with expectations. So you're not seeing much of an aggressive stance on any of the dollar positions on this print thus far, but certainly we'll be going over a lot of dollar crosses, guys. Euro dollar finally making the move to the upside. Dollar Swiss making a break of the weekly opening range low. Okay, you got Kiwi Cad broke the opening range as well. And we'll talk about the dollar, crude, Aussie yen, and of course, any other questions or trade setups you guys want to review, please feel free to post on the message board. Again, a quick reminder, I see some new names. There is a camera button in the top right-hand corner of your GoToWebinar screen if you want to take a freeze frame of any of the charts that you see presented on the webinars. Parmendra, good morning to you as well, my friend. Great to see you. So, with that in mind, later in the day today, you do get some market service PMI and composite PMI numbers at 9:45, just at the close of the webinar here. We'll want to pay attention to these. This is the first read, or is that the first or final? It's the final read, excuse me, for the month of February. We are expecting an upward tick here in the PMI. We'll be looking for this one more importantly, even more so than composite, the service PMI numbers, to see if we get back to neutral territory. Remember, with PMI data, anything sub 50 designates contraction. Anything above 50 denotes expansion. So certainly we're looking for a more benign print here from the contraction we saw. That's at 9:45. 10 o'clock, you do get the ISM non-manufacturing composite, which will also be a decent read here, looking for a slight downtick for February. Factory orders will be the biggest read today. As it pertains to January trade, we're looking for a nice rebound from a decline of 2.9% last month to 2.1. Heading into non-farm payrolls, just a quick review. Market expectations are still calling for about 195,000 jobs, unemployment at 4.9. We'll definitely be interested in looking at the labor force participation rate that's continued to come off lows not seen since the 1970s, and certainly we're expecting yet one more uptick here to 62.8%. So these are going to be the major three reads that we'll want to look at, guys. Obviously, the headline unemployment rate, the headline non-farm payroll print, labor force participation, and last but not least, very important, is the average hourly earnings. We continue to see that wage growth inflation has been something that the Fed has cited as one of the main things they've been looking at and trying to target that 2%. So on the back of that PCE number that we got last month, the personal consumption expenditure, which came in slightly better than expected, an uptick in average hourly earnings, guys, is going to put the pressure right back on the Fed to begin the normalization process, i.e. moving on interest rates to the upside. And certainly if we take a quick look at what market expectations are now, we've been looking at this, guys, for the last few weeks. This is the Fed funds futures rates, what market participants are factoring in. And we were looking at broadly September into that November read. Really is where you started to see this sort of from 40% now down to 38, suggesting that there's a slight, from here we were at 50%, now moving towards 40, which means a slight uptick in expectations that we will start to see rates moving higher. And that percentage or that probability starts to really amass now in July. We're seeing a shift here from 60 down to 56. So it suggests that, again, as the data continues to come in and the stronger the data comes in, the more likelihood we'll start to see these percentages move more so towards the probability of another 25 basis point hike, probably in Q2, if not the second half of the year. Okay, as it pertains to this month, the interest rate decision that we're getting on the 16th, there's really very, very little probability that we're looking at as far as market is concerned on a hike this month. That doesn't, like I said, doesn't really start to mass until you get into June, July, where percentage is starting to build up a little bit. So what impact will this have on the dollar? Well, we'll have to see where we are as we get deeper into the month, closer, and get that March interest rate decision out of the way. Looking at the dollar index, here's what we are sitting at today. So that key support structure that we've been talking about, major key pivot, we've been talking about it for 4 months now. It's 12,123. The April high day close, you got the 2016 open at 12,131. We're testing that key support region right now. On the near-term structure, which I'll show you in just a moment, the downsiding slope also has the lower median line parallel catching this right here at this point. Don't forget, you have that 100-day moving average in there as well and has offered a really nice pivot in price. So certainly the focus today is, are we going to close sub 12,123 and are we going to push below 50 on a close basis on this momentum signature? Heading into the NFP print, again, it's important that we remain very nimble as we get into the later part of the session, US, and specifically heading into Asia. You start to see that pre-data lull start to come into play. Although the non-farm payroll print is not going to be quite as critical this time around, just because where the labor markets are in general. Obviously, any deviation off the expectation is sort of what we'll be playing. So look for this near-term support here as it stands right now on this session. Here's what the performance looks like for the dollar. You got the Aussie with the biggest gain in the session, up 0.56%. Nice breakout there, testing near-term resistance soon. Kiwi with a similar move. Swissy and Euro, finally, the two that we were really focused on all week, have made the break. Dollar Swiss to the downside. Euro dollar shifting off that major key low. Sterling kind of a snoozer here today, and the yen with a nice near-term advance or near-term decline here, excuse me, of 0.31%. Now this is versus the dollar, but we've seen some broader yen losses, and one of the best performers has been Aussie yen with that breakout to the upside, now testing near-term resistance. All right, let's jump right into the charts. First up on tap, I just want to show you the near-term outlook here for the dollar index. This is what we've been following over the last couple of days. We presented this on Sunday's report. Here's that major key area of support. And this is just a pitchfork, guys. I don't know if you remember this yesterday. We just tacked this on during the webinar yesterday. We didn't know if it was going to be a major player. We only got one rebound off the median line, but certainly the reversal off the upper median line parallel gave us a little bit more conviction to stick with the slope. Now, while yesterday's decline did break the lower median line parallel, a slider of the same slope connected to the initial opening range low we made on Monday looks like it's catching the lows really well here. Okay, and then there's that key support. Long story short, we're looking to sell rebounds. Okay, initially you'd look for resistance right at former support. There's that 100-day moving average, which has offered a very nice pivot in price. And a rally towards this area into the open of US trade. We'll be looking for short triggers. At the end of the day, we're going to lower our bearish invalidation level that we cited last night at this confluence. We're going to lower that now to that 12,154 level. Okay, really nice pivot here that we made last week, and also converges right on that median line off the high heading into US. So this is going to be our bearish invalidation level. You're looking for a rally to sell a downside break. You got a couple of near-term targets I just want to be mindful of. The median line, okay, for the operative slope that we've been in on the daily right here, comes in just lower. I'd be looking at 12,108, 12,105, this region right here. This is the 50% retracement of the advance, of this near-term advance. And then again, that median line. And once we clear this, it's sayonara. I mean, basically the major key support you'd be looking for is that longer dated 38.2 at 1250, and that is dead on with the 200-day moving average heading into non-farm payrolls tomorrow. All right, so clear-cut levels here on the index ahead of some major US dollar event risk is something good to see. And certainly on the move that we saw with the break of the weekly opening range to the downside on the index yesterday, the break of the weekly opening range to the downside on dollar Swiss today. Euro dollar hasn't broken the weekly opening range just yet, but certainly we are looking for a possible rebound on that front as well. Any questions on the dollar index? A clear picture here heading into non-farm payrolls. And again, even if we can't trade this, if you're trading stateside, a very nice barometer for broader and base dollar movements. All right, so that is the dollar index. Moving right along. On tap from yesterday's intraday update, just want to give you a quick recap on the Kiwi Cad. This is also a setup we've been following for a couple of weeks now. Not really a pair that you see too much commotion about, but it still continues to be very clean. Here's what the daily chart looks like. Let me bring that up for you real quick. All right, so if you guys remember earlier in the week, we were talking and really just highlighting this major key support. We've adjusted and reworked some of the levels to the downside just to reflect what price action has done. We were originally looking at the 50% retracement. And you can see this, by the way, guys, on all the reports, if there's a previous one that pertains to it. I always try to include the link there for you. You can see earlier in the week, this was back on the 29th, we were talking about this major key support at the 50% retracement at 89. Okay, we dribbled down just below, and at this point, I don't want to be looking at 89 as much as 88.76, and that's now the low day close. All right, so that's what we're going to readjust that level, bring it down just a little bit, omit that 50%, and now we're working with a key support of 88.75. Again, that's the yearly and monthly low day close at this point. So we're getting that rebound now. Again, here's back to yesterday's update. We were talking about this near-term resistance level. I had a short off this. I'm not going to lie to you guys. You had some nice divergence. There was a trigger break on the near term. We're only looking for 27 pips. The thing stretched down to 26 pips. I never got triggered on the limit, and on the rebound and overnight trade, I got stopped out at break even. So no harm, no foul, I guess, but certainly the break above 89.78, guys, is a basic and objective weekly opening range break. Aside from what Mike Boutros thinks, aside from what Jamie Setley thinks, at the end of the day, an objective way to play this, you got a break of the weekly opening range. We're looking on that rally up into 90.43, 90.60, nice confluence region of resistance. You can see it here on the daily chart as well. This purple line that you're looking at here, if I'm not mistaken, is the 2015 open. Yep. And you can see a very nice pivot here. We've been making some really nice pivots along that region. It's also the 618 extension off of the lows. You also have former trendline support. Just zoom this out for you real quick. Former trendline support, pivot, resistance, resistance, also confluences right there. And add to that, in case all that wasn't enough, you have a basic upper median line parallel for the downside slope, which also converges in this region over the next day or so, 2 days. So still some more upside to go here on the Kiwi Cad. Here's what the 30-minute looks like. Very, very clean from even a momentum standpoint. So we were talking about the possibility yesterday as this thing, here's where we were basically when the webinar was playing out. We were just coming off the lows. We highlighted this key region of resistance, and we were also talking about the fact that, look, the momentum signature still remains bearish. And the way you want to play these guys, when you want to look for the reversal play in just pure momentum, is after, subsequent to the 60 break, if we get a break sub 40, or specifically even more so sub 30, the real test is on the rally here and whether we turn ahead of 60 again. That's how you know that the broader downtrend's still in play. Okay. Now, once we dipped below 40 and then we came back and found support or reversed ahead of 40, now something's up, right? Just so happens that you got a trigger break to the upside there later in the day. You had a really nice opportunity to take a very tight stop against the opening range lows. This was actually the European lows. And then on the break back above 60, that is a validation of a shift or a turn in momentum. Okay, so from above 60 to below 40, you need to see that break back above 60 to reverse the momentum profile, and we got that last night. So I don't want to keep beating a dead horse. Nice trigger again, an overnight trade got me another opportunity to get long here right ahead of the U.S. futures market open on this stretch to the upside. Again, looking for 90.45, looking for 90.60 at 38.2. Again, that upper median line parallel comes in on this rally, on the stretch. Once we get up into this region, short bias is, or the long bias, excuse me, is at risk. Okay, and as we get up into this, we'll be looking for possible momentum divergence. We'll be looking for short triggers to take it back to the downside. But on a holistic approach of just the opening range strategy, a break of the weekly opening range tends to see a Thursday, Friday high. Well, it's Thursday. So I'd be looking for a possible high stretch into the close of US trade today, maybe a stretch into Asia. A topside break above this median line really takes a different picture on the entire trade and shifts the focus right back to the upside again for the operative slope off the lows from last year. Okay, so certainly we'll be looking for, with great interest, and once we get into that 90.40, 90.60 range here on Kiwi Cad for possible turn back to the downside. Any questions on this pair? Still like it. Really, really clean levels. Not very big ATR, so if you're newer to the strategy or just kind of wetting your feet here, might be a nice play as we get into the latter part of the week should be rather benign to a degree to the non-farm payroll report. Wouldn't expect to see too much volatility on this. As far as CAD data is concerned, you're pretty quiet until you head into next week. So there's really nothing on tap into the close of the week here. Any questions on Kiwi Cad? Here are some of the triggers that I was looking at this morning for Kiwi Cad. You had a couple of triggers here in Tokyo trade. This is the one last night that would have been sort of your ideal entry for a topside pop. This is after we broke above the opening range highs. You had another one right, like I said earlier today, right on the onset of the opening for US futures markets. That again keeps you to the upside. And even on a near-term prospect, guys, just over the last few sessions since the essentially since the low that we made in price this week, for the week, you can see from sub 40 to above 60, 40 hold, 60 break, 40 hold, 60 break, 40 hold, 60 break. Constructive momentum signature. Okay, and that's just on a 5-minute chart. So some things you want to take into consideration when we're jumping into these intraday type positions. Questions on Kiwi Cad? No, have not, Craig. Craig says, hi, Mike. Sorry to be late. I'll go back and look at the archives to see what I missed, but have you already covered the Euro crosses, particularly Euro Kiwi? Craig, I haven't, and I haven't actually been tracking Euro Kiwi, so we'll definitely take a look together here, no problem. This is the first currency we're on, except the dollar index, Craig, so you're right on time, brother. All right, so moving right along, that's sort of the only major new update I wanted to give as far as the intraday update from last night. The radar chart from last night's radar charts, excuse me, just really wanted to give you an update on the trades that we've been following. Aussie Yen, dollar Swiss. So let's bring up the Aussie Yen chart first. This saw a clear, definitive break of the weekly opening range earlier in the week here. We were talking about that break above 82 is what was needed to really validate a more meaningful advance here off of the major support that we've been bobbling off of essentially for 3 weeks. The topside break initial targets were 82.45. This was a nice region of resistance. Surprised to see this break last night, but you had a clear-cut trigger. Topside resistance, you're looking at 83.47 as a soft target, but more importantly, a basic trendline resistance. And that basic trendline resistance, let me bring you Aussie Yen real quick, is a little bit more clear to see here on the daily chart, okay, right off the December highs. And that's exactly what we're testing now. And remember what we talked about on Sunday, or on the Tuesday webinar, guys, early in the week. When these ranges coil for this long, this is almost a 3-week opening range that never gave out. This tends to be the result, right? A decisive break, a lot more easily more. Let me take a step back. I'm on the last words today. It's easier to trust, right? Because you're seeing a range that has been so well defined, and specifically on the low bounce here, and we talked about this outside day reversal candle off of the low day close. That's your most conviction reversal signal that you're going to get. So certainly we were looking for the break. We got it. Now testing near-term resistance, and the long side is at risk below this level near term. Here's what Aussie Swiss looks like on the 30-minute. So again, there's that trendline resistance. We hit that soft target earlier last night, right in Asia trade at 83.50. And again, a breach above this region would really give us a lot more conviction to playing a much more concerted advance here for the Aussie Yen. You're looking at 84.28. It's just a basic 764 retracement. More importantly, this region here at 84.67 into 84.72. That's 100% extension off the low. So 2 equal legs up, and the 2015 low day close. So again, clear-cut targets here, a little bit wider of an ATR. Keep in mind, you're looking for about 41 pips, 40 pips per scalp on this, and gives you a little bit more room for play. But I'd be hesitant to really aggressively chase the long side from here, guys. So heading into the US trade session, I'd be looking for either a possibility for actually a short exposure. You have some divergence here into the highs for a little bit of a pullback. Well, again, that'll probably be a half leverage trade if we do take it. At the end of the day, you need to get back below this region to try to be a little bit more comfortable playing the short scalps to the downside. Opening range broke. It has broke earlier in the week, so wouldn't be surprised to see that high stretch come in today in US trade. Question from Eileen saying, Aussie Yen at this level right now, right at resistance, wait again for the break of that trend line to continue looking long, or waiting for the pullbacks now to get long again? So we can play it both ways. Eileen says, no, you answered it. Thanks. Oh, okay. Sorry for the delay there, Eileen. Yeah, we could play it both ways. If we see the U.S. Open start and we get a nice short trigger, again, the momentum here does have me giving a little bit more of a waning profile to the upside momentum swing. You could see a nice pullback, but I wouldn't get too aggressive on it. Okay, I wouldn't get too aggressive on it by any means, because we are fighting the near-term trend still. Let's see what the 5-minute chart looks like on this. Okay, so you're seeing some divergence also on the 5-minute chart. Price action pushing to a new high, the oscillator pushing into a lower high. Looks like you actually just got a decent trigger here. And something like this, both of which suggest you might see some downside near term. That'd be sort of your invalidation for that idea. If we break through this, you're probably going to get another run at the highs. And the only other thing I want to look for, Eileen, if you're not holding shorts already off those triggers, is the 1-minute chart. You saw some breaks here below 40, but a quick recovery back into overbought territory. So I want to see if we can kind of break this spell or stint that we're holding 40 as support. But generally speaking, yeah, I'd be looking for a pullback here on the immediate front heading into the US Open. Does that make sense? Eileen says, yeah, no shorts yet. Actually looking for shorts on Aussie dollar, and makes sense. Exclamation point. Cheers. Right on, Eileen. Good point on this. So yeah, absolutely, guys. Feel free to play a little bit of a pullback here. But again, as we get into the 83 handle, we'll want to be a little bit more mindful of a possible pop higher. And by the way, the bullish invalidation level on this trade still has to be down at 82. Okay, just on the count of your objective. It wasn't even an opening range. Your objective range break that you got. It wouldn't be outside the realm possibility to come check this as support here first. Again, the range highs as support, form a resistance before you get a rebound. But generally speaking, you're at risk for a near-term pullback here. So that is to say, any shorts we take would need to be against the highs. And if we do get the break, the only thing I do want to just preface it right here is that there's really no major key targets until 84.28. So you have a much wider stretch to the upside, guys. If we open up the US session and this thing pops through 83.70, 83.67 here, you're likely to see a rally all the way up into that 84.28 level, almost 60 pips to the upside. Okay, so that is Aussie Yen from last night. Next up on tap, and my favorite play so far for the week is still dollar Swiss. It was a little bit of a stubborn play, but I mean, you don't get these really clean opening range breaks, guys, right off of a major upper median line parallel and a key support, former highs. Very, very, very clean price action. Remember yesterday, we were also talking about the fact we're looking for a break of this 40, 60, 40, 60, 40, 60 that we made since the weekly high. And certainly we did get that conviction break sub 40 last night. Here's what dollar Swiss looks like first on the daily, just to give you a quick reference on where we are in trend. Okay, and the whole premise of the trade, guys, again, this is, like textbook TA right here. You don't get things this clean this often, so make sure that we do take advantage of it. Waiting on this trade earlier in the week as we were trading in that opening range that was just holding above that 200-day moving average. I think it was worth it to be a little bit more patient and look for this break. So again, objective break of the weekly opening range, break sub the 100-day moving average at 99.60, shifts the downside and focus. Your first major key support doesn't really come into like 98.50, and that's the 50% retracement. But more importantly, it's the swing lows that we made last week. So you have a nice confluence region there, and that gives you a nice range of over 100 pips here to the downside if we do get a move off that 200-day moving average. Here's what it looks like on the 30-minute chart, even cleaner. Okay, so there's your weekly opening range. There's that momentum that we were looking for in the consolidation. You got a break. This is the trigger that you're looking at here. Another trigger formed in overnight trade. Got a break to the downside. This is your first break sub 60 since the lows. And here's the progression of the trade, looking for initial targets at 98.30. It's at 38.2. And then again, like I said, 98.50, that low from last week, just above it, 98.52, and then the 50% retracement, 98.48. At this point, we'll want to adjust one quick thing and make the bearish invalidation level. I'm going to go ahead and drop that to yesterday's highs in Asia, i.e. highs in London. Pretty close. Okay, so we'll set the bearish invalidation level at this point right at 99.80, 99.81, the highs that we saw in overnight trade. Again, we would need to break back above the opening range low. Wouldn't be surprised to see this at resistance before we move off into US, but nonetheless, as long as we stay here, we're going to continue to look bearish. The bearish invalidation level, what would shift our bias to the upside? Very simple, break of the overnight high and the upper median line parallel. Interestingly enough, let me just, this just kind of popped at me right now. I just want to see if this slope, a sliding parallel of this slope does in fact catch those highs. Close, close, but no cigar. Just going to leave it there for reference. Sort of another level to look at just as a break validation to really start getting more aggressive on the long side if we do break. But as that, all things held constant, guys, we're looking to sell rallies here in dollar Swiss, targeting 98.92 and that 98.50 level. Been waiting for this one for a while, so welcome this break to the downside. And again, I just want to get preface this before getting too excited. I do want to see the dollar index push through this, okay, to really get the validation. Keep in mind, this is at support heading into the U.S. Open and heading into U.S. data tomorrow. So, you know, the break tomorrow, or if we're still lingering in these levels tomorrow, it certainly will give us a little bit more opportunity for a more major reaction, as it were, if we do get a deviation in non-farm payrolls. Questions on dollar Swiss? Okay, dollar Swiss on the books. Break of the opening range low shifts us lower, and we'll continue to look at selling rallies here. Aussie yen, we went over. Last but not least, the dollar index. We talked about this near-term short chart as well. Again, testing that 12,123 level. A break there is really what's needed to get this thing going. And we reviewed those levels earlier in the session. I do want to go over some other extraneous pairs that we've been following, i.e. gold and crude. Also, you know, I think there's some really interesting pending price action in gold that we're going to see very shortly here. Give us this breakout as we continue to consolidate into the apex of this triangle consolidation formation. We presented this chart on Sunday's update. As we opened the week, we came into resistance, we moved off, didn't quite get a tag of the lower parallel or the lower trend line here before turning right back up. That gives us a little bit more indication of where momentum stands, remaining to the upside, keeping in mind that these triangle formations typically, not always, there's nothing 100% trading, but typically are continuation patterns, which suggests we should be inevitably looking for the topside break. And certainly if you see the dollar index break sub 12,123, guys, that's all the more conviction if we do see a mounting assault above 1246 in gold to really trust that rally, okay? Here's what gold looks like now. We'll start off on the daily chart just to give you some reference. Okay. Again, I don't think it gets much cleaner. I think it's pretty self-explanatory. As we talked about yesterday, if we do get through the high day close, 1246, remember 1263, the high stretch for the year. Not only is it the high stretch here, but again, that sliding parallel that dates back to 2013, and we'll want to take that into account. We reviewed that yesterday. That's really going to be the breakout zone, as it were. With a move there, really looking for a rally into the 2015 high week close and the 2015 high day close just higher. All right, so clean levels on gold. Momentum isn't really giving us much of a conviction on a trade like this. You kind of just really need to watch price action. Here's what the 30-minute chart looks like. The weekly, well, I might as well give you a little quick picture here. Here's the weekly chart. It's not going to offer anything. Again, basic 786 retracement. This is off the decline from last year's high. Basic trendline resistance. And it's actually also turned out being a basic 236 from the all-time record highs that we made in 2011. So big level here for gold as resistance. And even if you look back here at the cursor, guys, going back into the 2010 peak high that we made there mid-year in June, pretty darn close on a closed basis for the weekly high as well. So major big region with the triangle consolidation taking shape just below. Here's the 2-hour chart. Okay, 1246, there's that confluence region now. Again, high day close with the upper triangle resistance. Momentum holding 60. Haven't seen a 40 break. Look for a break of this region, aside a break of this consolidation. Again, with ultimately a topside pop favored in gold. Questions on bullion prices? Biggest upside risk heading into tomorrow's non-farm payroll is a weaker than expected print. Either a deterioration in labor force participation, a strong miss on wage inflation numbers, or just a complete miss on the headline 195K that we're looking for. If that comes in sub 150, sub 140, you'd look to see the dollar really start to lose some more steam. Interest rate expectations get kicked out. Gold as a bid against some of these declines that we're seeing, and no yields could see a pop to the upside here through 1246. And that moves us into crude. And it's been interesting for me watching all these crude commentary guys over the last couple of days on Bloomberg and CNBC and Reuters. You know, everyone's got their own view of what crude is doing. And I think some of the calls are just completely outrageous. But for us, as always, the only thing that's going to guide our judgment is price action, guys. Don't listen to any of this nonsense. You know, some guys are calling for a rebound back into 50. Some guys are still calling for $15. It's just, even the bank research, guys, the banks have been completely off on this call, completely. And in fact, it's funny because once we first got that break here to this last month on the 22nd, this is really what validated for us a topside bias in gold, or excuse me, in crude. Okay, you had a really nice clear break of the median line for the current operative formation off the highs from last October and last November. You had the first break above 50 that we've seen in almost 4 months. And certainly on that kind of rebound, taking you right into the open for February trade before halting on the pullback, finding support right at the same median line we just broke in. So this was an obvious sort of near-term breakout mode. The 50 level also gave out last week on this push through the key 618 retracement. So here we are. I still think you can get a stretch higher. Okay, the major resistance, I'd be starting to look at the beginning of 35.30 into 35.50. This is a 618 extension off the low. And this is a 38.2 retracement off that same high for the measured median line formation that we're in. So within the confines of that, you also get the current operative slope that we're working with off the lows. So this whole region, with everything that we just noted, all converges on that same slope resistance. So even the nature of the ascent, the nature of the decline, and the measured moves all confluence in this key region. So it really does stretch up into, and I just want to put as a preface, to 36.18, which is the 28 low. But more importantly, I'll be currently looking for a close at 35.34, 35.50. As you head into this region, the near-term focus starts to shift to a possibility to the downside. Or let me say it in a different way, the long bias starts to become at risk. So the closer to get to 35, if you're not already holding positions, I wouldn't be looking to do anything new. In fact, on a move tomorrow, you might see a spike high push right into that region before recovering. Is sort of a play I might be looking for here in crude. At the end of the day, 36.18 is what I'm denoting as the bearish invalidation level. Okay, and if we break above this, you're no longer in this multi-month, 5-month long formation. You've already broken through back through the 2008 lows, And a move like that would certainly shift the focus all the way up into the April low day close, i.e. the 50% retracement with that 100% extension coming right in the middle. That gives us a range of 38 into 38.47. So again, a rare trade where the technical levels are just so clear, and we've continued to see some really nice plays off them. So we'll continue to watch 35.34, 35.50 as near-term resistance. Bearish invalidation for the broader decline off the October highs is still going to be at 36.18. Questions on crude? Doesn't get much closer than that, much cleaner than that. Okay, moving right along, let's jump into the euro dollar, and then Craig, I want to jump to the euro kiwi for you. I'm interested to see what that looks like. I haven't even looked at it yet, but here's what the euro dollar is doing. No surprise to anyone here. It shouldn't be with what we're seeing in dollar Swiss. Here's euro finally making a move off that low we were talking about all week long. You're basically looking at the 2016 open confluence with a basic 764 retracement off the low. This is of the entire 2016 trading range. Interestingly enough, despite all those wicks that we saw on a major, looked like a complete collapse below that major support confluence, no closes below. And this is why we stress, guys, really to validate a near-term bias, we want to see the daily close there, because you can get spikes like this to the downside or through resistance, and you're going to get faked out. So before I want to start trying to push longs, I want to make sure that we close above this region. And in fact, if you bring this into a line chart, it looked like it never even probed. See how clean that looks? And that's what you want to see. It's exactly what you want to see. So long story short, to put things in perspective here, the near term, you're looking at the high day close, the high day reversal close for December. No, it doesn't look like it, but it is the high day reversal close for December. That's right here at 109.22, if I'm not mistaken. $109.24. Okay, and that's backed very closely by the 100-day moving average, which again has been a very nice pivot in price. Okay, catching the high right on that same high day reversal close we're looking at right now. So that gives you a range of 109.24 into 109.32 of near-term resistance here for the euro. Also note that the momentum signature is turning again, right ahead of that 40 level to the downside. Here's what it looks like on the 30-minute chart, a little bit cleaner. So really messy on this. Again, every spike low and push through that major key support that we were looking for ended up closing the session well above. Okay, first 60 break of the week. The opening range high doesn't come until 109.55, 109.60, 109.65 here. So you got some room, but on just an objective look of a basic channel, this is not even a pitchfork, guys. This is a basic channel. Here's basic trendline resistance. You have the 100-day moving average. And again, 109.24 into 109.32 is estimated key near-term resistance here for the euro. Okay, we're going to maintain at this point a bullish invalidation level of the same region. Okay, the 2016 open, 108.72, that's 764 retracement. And as long as price is able to stay above this region, i.e. those highs that we made yesterday in US trade when we kind of butted right up against it, we'll continue to favor a near-term topside bias. To validate a breakout play, we need to mount the opening range high. Now, keep in mind the opening range high on this is so beautiful, not only because it comes in right at that 618, but it's because it is very close to that swing low that we made last week. And certainly a topside break here would validate, in my eyes, a break of the descending channel. You're looking for a clear-cut target and major key resistance at 110.45. At this point, you got the 200-day moving average right there and the 618 extension. So very clean levels here for the euro. Hasn't been a clean trade all week with all that wick action, but certainly a welcome turn here in price and momentum. And like I said, we'd be looking for a break above 1045, 1055, or excuse me, we'll be looking for a break above that confluence of the 100-day moving average and the weekly opening range high to really validate a move with key resistance still up here, 1045, 1050. Any questions on euro? Keep in mind, ECB is on tap next week. Quick housekeeping, guys, real quick. I will be actually traveling to Colorado, Denver specifically today, so I won't be back until Tuesday. So we won't have a Tuesday webinar, but we'll be right back online here for the intraday strategy webinars on Wednesday and Thursday. So a quick reminder on that for your calendars. But for as far as next week's ECB interest rate decision, look, it's going to be interesting to see what happens. There's a lot of speculation that they might move on interest rates again to kind of mimic what's happening over the globe, not necessarily the deposit rate, but necessarily maybe a move on the refi rate. We'll see how that pans out and what kind of easing the ECB inevitably does. More importantly, the language. You know, Mario Draghi's language has been sort of, everyone's got an opinion on what he really means, and you know the markets really react on these statements of real strong support, will do whatever it takes, these kinds of things where it really shows a willingness for an expansion of the accommodative policy that the ECB has implemented. So keep that in mind, guys. That's going to be a big, sort of a big deal next week. Cheers, Eileen. Yeah, I'm looking forward to it. I'm looking forward to it. Going to take a nice ski trip over the Vale. All right, so loving the euro. I hope we get this rebound. Look for the break of the weekly opening range to validate and open up a much stronger ascent, looking for key resistance up at 110.45, 110.50. The euro Kiwi for you, Craig. Let's jump right into it, man. I want to see what this thing looks like. Oops. This looks very interesting here. Joe says, over your injury, that's great. Enjoy. Thanks, Joe. Yeah, I've been doing some physical therapy on the back, and knock on wood, thank God, we're feeling up to it. So couldn't cancel the trip. Couldn't bring myself to do it. Might be taking a little risk, but I think we'll be all right. So for this on this, Craig, again, just looking at it pretty objectively on the daily, I'll jump into the 30-minute in just a moment. The big break here, in my opinion, was this move. If this is, again, sort of a near-term consolidation that we were looking at, and the break to the downside, coming back and checking it, as resistance, in my mind, is sort of what validates the break of the support, checked as resistance, and a move to break the previous low. Now, we're not really seeing much follow through there, kind of straddling that median line formation. Let's take a quick look at what we're looking at in the 30-minute. And Craig, are you holding anything on this, or are you looking for new opportunities? Yeah, so I would take this as the opening range break. Here's your weekly high. You set a high, you kind of dribble into a weekly low. You didn't really defend that low at any point. So I would say that this is the kind of weekly opening range low that you set on the first. The second, you try to make a run at the highs. You fail miserably. Again, yesterday, kind of sitting there on another rebound, failing to even test the resistance. And this break and quick recheck as resistance is kind of what validates it for me. Now, it doesn't mean that this thing can't come right back up into 164 before moving off, but certainly would shift the near-term momentum lower. You can see that you also have momentum holding 60 as resistance here. If we draw a quick trigger off that, you'd want to be looking for resistance and momentum up near here. On the immediate bias, like literally now, again, I'd be mindful of the building divergence that you're seeing coming into the lows. And again, always remember, we're looking at the close, not looking at the candle. So bring it into a line chart. You can see a series of lower lows, a series of higher lows. If we do see the trigger break, expect to see a little bit more of a recovery, maybe even towards that, that trend line resistance. Let's see if we can mark up some near-term levels for you here. Again, let me just add on that extension. This is what I would be saying. He says thinking about a long trigger after it gets back above 163. Basically just the opening range high or those range highs he made in Europe. Well, this is what I got to say on this, Craig. It's a wide range scalp, so you definitely, by all means, you have the room. A quarter of the daily ATR gives you 62 pips per scalp. A trade like this, I only really highlight in the setups when it's really clear because the implications, obviously, of a bad scalp can get out of hand pretty quick. This is what I want to say to just be careful about trying to call a low. If you're looking for that long scalp on 63, okay, major resistance is 63.50 into 63.80, so that's barely going to put you at the quarter of the daily ATR. So I just would be mindful of that. Make sure you try to get that best entry that you can. If a break of 63, try to get the pullback. I wouldn't be buying at 63.20 or 63.15 break because you're really cutting it real tight. Also, if we take a basic retracement of just the weekly range, you can see that the 38.2 also comes in that same exact region. Okay. In fact, this is what we'll do. I'm gonna leave that retracement on for you. Highlight that. So there's sort of some near-term targets I'd be looking at with this being the bearish invalidation level. Okay, it's right below the weekly open, but it's the 50% of the range. And again, that major trend line that we've tested and held rather well, I might add, is right along that 50% retracement as well. So if we do get an extended break, if the momentum signature takes us through the 60 level and you do get a pullback and get a chance to get back in, I'd be playing, again, this is just a disclaimer, Craig. I'm not really interested in long right here. But personally, that's the level of which I would start to look at. My problem with this trade is this. I think Euro is on a rebound that might see a little bit more upside, but I also do think Kiwi could see some more upside before it turns over. Ultimately, I'm trying to sell the hell out of that thing, but Kiwi just has been refusing to, comply. It's funny. I mean, Jamie will often just yell at the screen, comply. This thing, the only validation that I have or that I'm looking at today, literally right ahead of the webinar, we were breaking through. So we'll want to see what the close looks like today. Remember the phenomena that we discussed yesterday, okay? Every time, and this is no joke, 5 out of the last 5 times that we've seen a break above the 200-day moving average, the following day has seen a mean reversion trade covering essentially the entire range breakout. Okay, even on this stretch, the next day, look how much higher we stretched. It looked like it was going to be a 2-day ripper. We closed way down here. So here's the first day that we closed above the 200-day moving average. If this holds, it could be another, do you know what I mean? Another pullback right back below 66.38, which is where the 200 is. I don't know. All I know is that we've been watching this slope resistance. We've seen obviously a clear-cut breakthrough this last week. I'm not really interested in trying to do anything here on the Kiwi yet. And that's my only real issue with the Euro Kiwi, man. I do inherently love a Euro Kiwi long on a breakout of that formation. All right, Craig. Inevitably, I would love a breakout in this because I do think that the Kiwi overall still has more downside to go. But as it stands right now, you made a break of the weekly opening range. Momentum still hasn't seen a 60 break. You've seen multiple 40 moves. Instead of trying to catch a fall in life here, let's see for a little bit more evidence of basing. Okay, I think that would be a little bit more stronger of a conviction trade for me. And you have the room, man. It's 62 pips on a quarterly basis. The market will provide. There's tons of volatility on a pair like this, and I really tend to only mess with them when there's a lot more clear picture of what's going on in near-term price action. Again, because the implications of a bad scalp can really sting. Craig, does that help, man? Does that make sense? He says, thanks, Micah. More than welcome, man. Good pair. Interesting pair. Not quite ready for me yet, but I'll definitely be looking for that price action. And like I said, if we do get into 64.25, a very, very interesting region, both on a possibility of a breakout to validate that upside bias that I would love to see in Euro Key, or if we see the Kiwi just completely blast through resistance versus the dollar, you might see a nice downside move from that level. But from here, I kind of want to see a little bit more of a major key support bounce, maybe on a 786 or something to that degree. Let me see just real quick where this 786 comes in. Okay, so I'm just going to do this. I'm going to get rid of that zero line because that obviously that's just designating the low, but I don't really think that we saw any type of major influential support down there to find a rebound. So keep your eye on that. What is that, 160, 177, Craig? It's also that swing high that you made right in that first week open range of 2016. Right in that first rebound, that was the high that we made, and a nice pivot when we rebounded off it as support. So maybe a little bit lower on a conviction momentum divergence into a trigger break. That might be a better entry. But that's sort of the idea I'd be working with. All right, that's Euro Kiwi. I have a question here from Dave saying Euro Cad finally paid me, trailing the rest. Euro Aussie will be next. Let's see on Euro Cad first. Right on, right on. I kind of got teed off at this earlier in the week when we saw this move break below the median line, but we held right at the 50 at the close, a clear-cut pivot in price last year. And again, yesterday, closing right at that level. Today, here's the rebound. My only concern is we want to be nimble on the long side here. I do think you get a sizable rally ultimately. I want to be cautious heading into 148 into 149.20. That's really where the key resistance will reside. A nice confluence region here of the 100-day moving average, the 100% extension off the highs, and a broader 38.2 off the lows all converge here. Heading into next week, more importantly, with that upper median line parallel. So if we extend this, by the way, I know Jamie's looking at this one. We were talking about this last night. I happen just to want to work with this just because of what we're seeing in near-term price. This is the deader slope, and like we always say, a deader slope will always be a little bit more of a better play for you guys. Markets don't tend to hold these really steep sloping pitchforks for too long, and you're 9 times out of 10, it tends out being a little bit better for us to work with the deader slope. So if we do that, my whole point of saying this is if we do that, look where the median line comes in. It puts that focus range into view a little bit more in the immediate future here over the next couple of days. So whether you're looking at that or whether you're looking at the original slope off the highs, just to put some things in perspective on where we're looking here. I do like where we reversed off. Let's see what EuroCAD looks like on the 30. Okay, here's your weekly open. Okay, a little bit different of a picture here because if this constituted the weekly opening range break yesterday, looks like we're making our way back above now. So again, here's the pitchfork off the high, which is the original one I was showing you here. And you can see the pivots that we saw off it to open up the week, which is why I was working with that slope to begin with. Nice little bounce, little bit of a probe here, but another bounce. And then more importantly, last night, if you look at this on the rally here, resistance, 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 it almost acted like a trigger right alongside the momentum trigger, right, from that high. So I don't know, to be honest with you. I just don't have a clear-cut picture on which is the better slope we should be working with. On the daily chart, I do like the confluence region there. On the intraday chart, looks like the steeper slope is giving us a little bit more of a better definitive price action pivot. Long story short, you've now, if this is a clear of the opening range low, now that we're breaking back above, and more specifically above the 200-day moving average, that would invalidate the short bias that came about yesterday on the first here. So look for the weekly opening range high, key 618, 4820, 4830 here on your initial target here on a stretch higher. Again, another ATR that's a little bit wider than your majors. Look at 53 pips as a quarter of the daily ATR. And more markedly is the divergence you saw into the lows. And this is the first 60 break you've seen of the week. So I'd be working with this as a range for now, guys, believe it or not. I know it's been a downside stretch of 7 days here, but for now, I'd only be looking to play into the range high of the week, if anything. If anything. If you take into account what we're looking at in gold, and if you take into account with what dollar CAD's doing coming off support here, that's CAD weakness. Euro CAD, yeah, could see some upside for sure, especially if dollar CAD is able to make a more concerted rebound. Keep in mind that gold, not gold, crude is coming into resistance we talked about, right? Still has some more upside to go before it hits resistance. So I'm not too crazy about getting short the CAD. I think Euro CAD will pan out. I think next week this will be something of great interest. Especially if we reach one of those extremes, both in dollar CAD at near-term resistance or at crude rebounding off that near-term resistance, I think you'll get a better play here. But for now, look for 140. I'd be looking for the weekly open, to be honest with you, first, if you're holding longs. But more importantly, the weekly opening range coincides with some nice levels here. But not a trade I'm too crazy about, to be quite honest with you, Dave. Is there something specific that I can help you out with on this? It's kind of just a quick overview of what I'd be looking at in a general theme, but not my cup of tea just yet. He says, would love some more down to get long off any new lows. Yeah, I'd rather play it like that. Although, let me take a step back. I would have liked to play along off this region, off this 50, and specifically on yesterday's close right there and failure to close below. That would have been a decent rebound play. More importantly, the low that I think would be a conviction trade would be something like down here. Basic trendline support, let me adjust that. Basic trendline support off the lows and the lower median line parallel off the highs. And again, if you deaden the slope on this, kind of doesn't pertain as strongly, if you can see what I'm talking about. So when I have these discrepancies where the intraday chart is showing me a little bit cleaner of a price action on a different slope, I'll tend just not to really participate or operate too much in that setup. That being said, broadly speaking, those are the levels I'd really be focused on. And if we do get that drop, say 44 essentially, might be a real interesting area here. So Dave, hope that helps. As far as Euro Aussie is concerned, I will take a quick glimmer on that, and then Aussie Key, Mario, I'll get that for you as well. We're running low on time, but we will stretch it here until we get all these questions in. So as far as Euro Aussie is concerned, I'm looking for a more major support structure down at 147.96, essentially 148, just below. This is just a basic median line, but even more so, just a basic trendline resistance. That was broken, never checked as support. That comes in just lower in confluence with the 764 retracement off of the advance from the December low. And more importantly, 618 key retracement of the 2015 trading range. All coincide right there. A break lower, I would be looking at 46.80, another area of interest. So let me just highlight these for you right here. And just lower right here. This is the lower median line parallel for the current operative structure off of this year's highs. So you got a range here, basically, of 46.80 to 47.90, a big 100 pip range or so, a massive ATR trade. So obviously, you want to use some caution on this, guys. But I do like a rebound off this region near term. heading into next week. I don't know if you want to press it necessarily this week. Let's see what the opening range for the week looks like. We never actually got one. Just zoom out here real quick. Okay. And there is that 50 line that offered a nice pivot break. There was break of support, failure is resistance, move lower. I would just like to see this thing come off base support, off the lower median line parallel. I think you get a decent rally from there. You can play into the 50 line where we start to look lower again. Right here, I don't have a play for you on this, Dave, at this level. He says Euro Oz will be next. So yeah, I would be looking for a move here. I'd be looking for a move here too. Same as Euro Cad. Love a drop lower, just near term to get on the long side. But if Euro is turning up from here across the board, I'd need to see a lot more conviction on a turn in momentum and a lot more conviction on a break of some of these median lines that are sloping to the downside before getting excited about the long on Euro Cad. Remember, guys, it's never worth it to try to call the low. Even if you do it and it works sometimes out of sheer luck, that's a bad practice. It's just a bad practice. So what I can tell you is, again, here, as we're seeing in some of these Euro crosses, some building divergence. Looks like a trigger break has already given out. Wasn't the cleanest break. But price action still holding the opening range for Asia and Europe real tight. So in fact, this might be a decent near-term play heading into the US Open. Let me bring up a 5-minute chart real quick here on Euro Oz. There's your London opening range. There's your Tokyo range. Range high right around 48.95. Yeah, so this is what I'd be looking at. For validation of a bias, this wouldn't be a trigger to jump into the position, but if we do break above that range, opening range high for London, and specifically if we do see a 60 pop, or a 50 pop rather, excuse me, on the 30-minute, and a more concerted 60 pop on a 5-minute, that to me would be some validation that we're seeing a turn in momentum. At that point, I would still be looking for a pullback towards that high to get long, but that's what I would want to see to be comfortable trying to fight the trend, guys. Because again, I'm just not going to be able to encourage trying to catch a low. Decreasing in wave, just a question of when. I completely agree with you. Yeah, I completely agree with you. Last question here. Mario says, so the Aussie key is testing the yearly high. And he says, I was looking for a quick in and out short on the rebound, but couldn't find any meaningful trigger. I know it's a risky business trying to catch the highs, right? So Mario, probably should have read that question like 2 seconds ago, but yeah. Look, again, near-term price action speaks to me, so I got no problem taking a quick, nimble scalp off of resistance. I do it all the time, but I'm in and out. It's a very, very quick move. It's nothing that you place an order for entry or anything like that, and that's something you have to see on a stretch. That being said, you saw a clear-cut break of the weekly opening range yesterday, so I'm looking for a Thursday, Friday high. I mean, what else could I say? Here's your Sunday open, okay? Here's your Sunday open or your Monday, Tuesday high. You test the Tuesday low, you come back on Wednesday to break through, shift the focus to the upside, looking for a Thursday, Friday high. Now, just so happens we're at near-term resistance here at 109.70, which is not really a fib level, more so than just the high stretch that we made back here in late January. So you are just basically testing the yearly highs. You're absolutely right. But you're consolidating in a nice range. Momentum is starting to hold below 60. That's a good development, Mario, for the turnaround trade. Absolutely. I didn't see that. That looks good. 50 break to the downside and a move below the range lows for, I guess this is US and Europe yesterday. For me, would be a near-term downside bias. Inevitably, you'd only be looking to play that into the opening range high for the week here. where you'd start again to look for some support, but could be a decent setup on this. Yeah, it could be a decent setup, Dave. But again, the opening range high stretch, I want to see some more conviction on turn and momentum. Also, a tell on this and a tell moving into the end of the week, Mario. The 60 level of momentum, we haven't seen a break yet this year. Okay, in fact, we haven't seen a break above 60 since way back here in May of last year, right? From the downside, once we broke 60 to the downside back in July after the high for the year, 60 hold, 60 hold, 60 hold, 60 hold, 60 hold. So the one good thing about this is that if you are wrong on a short scalp, the invalidation is going to be pretty clear. It's just going to be on a clear break above yesterday's high. Make sense? It is a risky business trying to catch highs, but I think you're on the right track looking for that turn right here. Absolutely, you're at resistance. He says thank you. You're more than welcome, man. More than welcome. So, guys, if there are no other questions, we are over on time. I'm going to go ahead and wrap things up here. I want to wish everyone the best of luck heading into the end of the week and non-farm payrolls tomorrow. Remember to stay a little bit more nimble, okay? It's the close of the first week of March trade. Next week actually sets up the first opening full range week for March trade, so that tends up to be a nice time for trading as well. And then again, with the ECB on tap, the Euro crosses are going to be of great interest. We'll take a better look at those guys, the Euro Aus, the Euro Cad, Euro Key for sure heading into next week with some of that event risk on tap. But for now, keep in mind those Aussie crosses. I really think that they're in a very interesting area. The dollar Swiss and the Euro dollar is something that I'm currently operating in as well. And, hopefully we'll get a little bit more clarity on a definitive dollar break as we head into tomorrow's non-farm payroll print. Enjoy your trip. Stay healthy. Don't overdo it, says Joe. Cheers, May. Eileen says, thanks for all the sessions. You'll have a brilliant travels here then with the wonderful clear weather as you travel. Mountains are full of snow. Vale feeds the soul. Happy skiing. Enjoy. Amen, Eileen. Love the commentary. All right. Guys, we'll wrap it up there, and we will see you next week. Best of luck. Cheers.